Today's video is about financial management topics. For today are finance manager and types of finance manager, role of finance manager, functions of finance manager, introduction of time, value of money, reasons of preference of time, value of money, techniques of time value of money, financial decisions. Hello. Namaste. This is yours, Himalayan Soul with ChatGPT. Let's begin with today's topic. Finance manager and types of finance manager. Who is a finance manager? Definition. A finance manager is a person who manages the finances of a business efficiently and effectively. Example. A finance manager at a company ensures that there's enough money to pay salaries, buy raw materials, and invest in growth while avoiding wastage. Types of finance managers. 1. Corporate financial manager manages overall financial health of a company. Example. Prepares financial statements and budgets. Second treasury manager handles cash flow, banking, and investments. Example. Ensures company has enough liquidity to pay bills. Third, risk manager identifies and controls financial risks. Example. Creates insurance plans or hedges against currency risks. 4. Investment manager manages investments to grow company funds. Example. Invests in stocks or bonds for better returns. 5. Financial planning and analysis, FP&A. Manager plans, budgets, and forecasts future financial performance. Example. Prepares 5-year financial growth plan. 6th. Controller manages accounting records and internal controls. Example. Makes sure all expenses are recorded correctly. 7. Tax manager manages all tax-related matters and filings. Example. Files GST and income tax returns to avoid penalties. 8. Audit manager conducts internal or external financial audits. Example. Checks if company financial practices follow legal standards. Role of finance manager. Role of finance manager 1. Raising of funds. Arranging money from various sources like loans, equity, or bonds. Example. A finance manager gets a loan from the bank to buy new machinery. 2. Allocation of funds. Deciding how to use the available money in the best way. Example. Allocating funds to departments like production, marketing, and R&D. 3. Profit planning. Making plans to increase profits by controlling costs and improving revenue. Example. Creating a cost-saving plan to increase the company's profit margin. 4. Understanding capital markets. Knowing how stock markets and financial instruments work. Example. Issuing shares to raise capital through the stock market. Functions of finance manager. Primary functions of a finance manager. 1. Estimating capital requirements. Find out how much money the business needs. Example. Planning 50 lakh rupees for a new project. 2. Financing or capital structure decision. Decide where to get money from. Loan, equity, etc. Example. Choosing between taking a bank loan or issuing shares. 3. Utilization of funds. Investment decision. Use funds wisely for best returns. Example. Investing in a new product line. 4. Disposal of surplus. Dividend decision. Decide whether to give profits as dividends or reinvest. Example. Giving 10% profit as dividends to shareholders. 5. Cash management. Ensure the company has enough cash for daily needs. Example. Keeping 5 lakh rupees aside for monthly expenses. 6. Finance control monitor and control how money is spent. Example. Auditing expenses to avoid overspending. Subsidiary functions of a finance manager. 1. Ensuring optimality. Make sure money is used in the best possible way. Example. Choosing energy-efficient machines to reduce cost. 2. Funds supply. Ensure timely availability of money. Example. Keeping funds ready for salary payments. 3. Evaluation review financial performance and plans. Example. Analyzing whether a past investment was profitable. 4. Keeping track, maintain records, and monitor financial data. Example. Tracking daily income and expenses in software. Introduction of time value of money. Time value of money, TVM. Definition. Money received today is worth more than the same amount received in the future. Example. 100 rupees today is better than 100 rupees next year because you can invest it and earn interest. Features of time. Value of money. 1. Opportunity. Cost of money, money used now can earn returns if invested. Example. 1,000 rupees invested today may become 1,100 rupees in a year. 2. Impact of inflation. Inflation reduces the value of money over time. Example. 50 rupees today might only buy items worth 45 rupees in the future. 3. Compound interest earning interest on both principal and previous interest. Example. 1,000 rupees earning 10% compound interest becomes 1,210 rupees in 2 years. 4th. Risk consideration. Future cash is uncertain due to risks. Example. A borrower may not repay, reducing future value. 5. Discrete time periods. Time value is calculated over specific intervals, yearly, monthly, etc. Example. Interest calculated monthly gives more return than yearly. 6. Future value calculation tells how much your money will grow in the future. Example, 5,000 rupees invested today at 8% for 2 years becomes 5,832 rupees. 7. Present value calculation tells what a future amount is worth today. How to calculate future value, FV, of money formula, FV equals PV times 1 plus R to the power of T, where FV equals future value, money you will have in the future. PV, present value, money you have now. RT's interest rate, per time period, like per year. T for your number of time periods, like years or months. Example, if you invest 1,000 rupees at 10% interest for 2 years, FV equals 1,000 times 1 plus 0.10 squared equals 1,000 times 1.21 equals 1,210 rupees. Your money becomes 1,210 rupees after 2 years. Reasons of preference of time. Value of money time. Preference of money, meaning it means people prefer money now rather than the same amount in the future. Why do people prefer money now? 1. Risk future is uncertain. Money received later may never come. Example, a borrower might not repay in the future. 2. Preference for consumption. People want to enjoy goods and services now rather than later. Example, buying a mobile phone today instead of waiting a year. 3. Investment opportunities. Money today can be invested to earn more. Example, 1,000 rupees invested now can become 1,200 rupees in the future. Required rate of return, meaning it is the minimum return an investor expects to earn from an investment to make it worthwhile. Formula, required rate of return equals risk-free rate plus risk premium. The key terms. 1. Risk-free rate, the return on a safe investment with no risk, like government bonds. Example, 5% return from government securities. 2. Risk premium, extra return expected for taking additional risk. Example, 3% more for investing in company shares. Example, if risk-free rate, go 5% risk, premium 3%. Then required rate of return, 5% plus 3% equals 8%. Techniques of time value of money. Techniques for estimating time. Value of money 1, compounding future value technique, used to find the value of present money in the future. Formula, FV equals PV times 1 plus R to the power of T. Example, 1,000 rupees today becomes 1,210 rupees after 2 years at 10% interest. 2. Discounting/present value technique, used to find the current value of money to be received in the future. Formula. Example, 1,000 rupees received after 2 years is worth 826 rupees today at 10% discount rate. Techniques for estimating time value of money. 1. Techniques of time value of money. These are methods used to find how the value of money changes over time due to interest, inflation, and risk. There are 2 main techniques. Compounding, future value. Discounting, present value. Financial decision-making, investment decision. Investment decision, meaning it refers to the careful selection of assets in which a firm will invest its funds to earn returns in the future. It involves choosing where, how much, and when to invest in projects, equipment, or other long-term assets. Types of investment decisions. 1. Capital budgeting decision, long-term, big investments for the future. Example, buying machines, building a new factory. 2. Short-term investment decision, small investments for daily needs. Example, buying raw materials, keeping cash for bills. In short, capital budgeting equals long-term use of money. Short-term decision equals day-to-day use of money. Importance of investment decisions. 1. Long-term growth and effects. These decisions shape the future success of the company. Example, investing in a new factory can increase production capacity for years. 2. Larger amount of funds involved. Big amounts of money are used, so decisions must be made carefully. Example, buying expensive machinery costing 5 crore rupees. 3. Risk involved. There's uncertainty. Investments may not always succeed. Example, launching a new product may fail due to low demand. 4. Irreversible decision. Once made, these decisions are difficult to reverse. Example, constructing a building cannot be undone easily if the plan fails. Financial decision-making. Financing decision. What is financing decision? It means deciding where and how to get money to run the business. The purpose of financing decision. To get money at the lowest cost. To keep the right balance between borrowing and using own money. To make sure the business has enough money to grow. Types of financing decisions. 1. Capital structure decision, how much money to borrow, loan, and how much to get from owners, shares. Example, A company borrows 50 lakh rupees from the bank and raises 50 lakh rupees by selling shares. Second dividend. Decision O, how much profit to give to owners and how much to keep in the business. Financial decision making. Dividend decision. What is dividend decision? It means deciding how much profit to give to shareholders and how much to keep in the business. Example, a company earns 10 lakh rupees. It gives 4 lakh rupees as dividend and keeps 6 lakh rupees for future use. Types of dividend decisions. 1. Stable dividend giving same amount regularly. Example, 5 rupees per share every year. 2. Constant payout ratio, giving a fixed percent of profit. Example, 40% of yearly profit as dividend. 3. Residual dividend is paid from leftover profit after all business needs. Example, after buying machines, leftover 2 lakh rupees is given as dividend. Factors affecting dividend. Decision 1. Profit. More profit equals more dividend. Example, high profit equals 10 rupees per share dividend. 2. Future plans. Company may need money for expansion. Example, plans to open new office, so gives less dividend. 3. Cash availability. Dividend needs cash in hand. Example, profit is high but no cash, so no dividend. 4th, shareholder expectations. Shareholders want regular income. Example, company gives dividend to keep investors happy. 5. Legal rules. Company must follow rules about how much dividend can be paid. 6. Taxes. High dividend tax may reduce the amount given. Interrelationship between investment, financing, and dividend decision. Interrelationship between investment, financing, and dividend decision investment. Financing dividends, company decides to invest in new projects. Company needs funds to do so. If money is not available from outside, company may reduce dividends to use profits for funding. If no external finance is available, investment may be delayed. Low retained earnings mean the company must borrow money. Company pays higher dividend to shareholders. If cost of capital, interest is high, fewer projects will be profitable. Using costly finance increases overall cost. Higher cost means company may not pay high dividends later. Investment decision affects growth. Financing decision affects company's strength and stability. Dividend decision affects shareholder satisfaction and financial policy. That's all for today. Thank you so much. See you in next video.